Hey, big question in 2026 with all the rate discussions. Should I or should I not buy points to lower my rate? Stay with me after this and we'll dive in and get the answers. Hey guys, welcome back. It's Aaron on 30A with Marsh Lending. So the question today is points, right? So in today's interest rates, they're a little higher than most people, would like to have, but there's a lot of questions on should I buy a point? What is a point? So let's talk about what are points. If you take your loan amount and you multiply it by 1%, that's your cost of the point. That's 1 point. So 1% of your loan amount is a point. Okay. So if you had $100,000 loan, $1,000 is what it would cost you to buy down the rate. Now, what does that mean, buy down the rate? What does that get me if I spend $1,000 on 1 point? Well, typically, or kind of standard for the industry, is it's about a quarter of a point off the rate. So say you had a $100,000 loan amount and it cost you 1 point or $1,000 to buy down the rate. And let's say the rate that your lender quoted you was 6.5. Well, it would take a quarter of a point off of that. So it would go from 6.5 to 6.25% as your interest rate. So that's what that would get you. Now, when does that make sense? Let's talk about the make sense part first before we talk about it doesn't make sense. So when it makes sense is you kind of answer a couple of standard questions. One of them is, how long am I going to be in this property? Am I going to be there 10 or 15 years plus? And I don't plan on refinancing that. When I purchase this point, it gets me to a rate that I'm comfortable with for the next 10 or 15 years. And do I have a lot of money that extra money that I can apply to that while still covering my closing costs and all of my monthly bills and everything, that allow me to get into the mortgage, right? So that's a question that you answer for yourself. Hey, I'm comfortable with the rate if I spend the money up front, and then I'm not going to refinance for a long time. Where it doesn't make sense, and this is more the standard than not, is you take that point difference, that $1,000, right? And then you see what the drop is in your monthly payment from the 6.5 rate down to the 6.25. And whatever that interest rate is, you divide that out and you see how many months it takes you to get broke even, right? Or so your break even point is right there. Where, okay, I spent $1,000 up front. How many of these months do I have to get the savings till I break even? And then if it's going to be a situation where you think rates are going to drop in the future, or you feel like you're going to sell or exit out of the property at some point before that break even point, then it doesn't make sense to buy the point. And in fact, to pay yourself back, you would probably want to have a long extended period where that point did catch up, break even, and make sense to you. So that's really kind of the two pieces of the points, right? When does it make sense? When I'm going to be into this for a long time and it gets me to a rate I like. Where does it not make sense? The payback period is way too long, and I feel like I can just refinance further down and I get a better interest rate anyway. So in summary, we covered a lot of, what is a point? What's not a point? When should it make sense for me to do it? When should it not make sense for me to do it? And hopefully you got a lot of good information out of it. Again, this is Aaron with Marsh Lending. Please like and subscribe so we can answer more of your important questions in 2026 around mortgages, interest rates, the market, everything. Until then, we'll see you on the next video.